Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and welcome to episode 12 of my Dow analysis series. In this video, we'll be doing a stock analysis on the 11th smallest company in the Dow by market cap, and that is Amgen, ticker symbol AMGN. And Amgen is a company that I didn't really know much about before making this video, and I'm actually pretty excited about the company and excited to share with you guys what I learned. So let's get right into it. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. So this right here is a spreadsheet of all the companies in the Dow, and I'm actually a few behind here. So we're right here on Amgen right now, and the last two videos we made in this series were on IBM and Honeywell. So if you haven't missed those videos, I'll leave some links up above and probably down in the description as well. You can check those out. But moving on to Amgen, the first thing that we're going to look at is their 2021 10K report, which was released a few months ago at the beginning of 2022. And this kind of talks about, how 2021 went for them, what some challenges were. It goes through all the financial metrics and they talk about, what they're looking for moving forward. So I just wanted to first of all start off with this shareholder letter or CEO letter to shareholders. So he talked in the beginning about their revenues were up 2% from the prior year to a record $26 billion. And a lot of their products were able to grow their revenues pretty substantially. So, 26% for Repatha, Prolia, 18%, Evenity, 51% revenue or sales growth. So those are pretty exciting statistics. And they also talk about research and development, which for a drug company is very important to be constantly researching and developing new drugs. So they invested $4.8 billion in R&D in 2021, which is up 15% from the prior year. And they talk about some significant regulatory approvals that they got for specific drugs, which I'm not going to go into all those details, but obviously you need to have all your drugs approved by the appropriate authorities in different countries. So that's pretty important and obviously a key step in making all these drugs. We'll talk about some of the numbers a little bit later, but I also wanted to talk about this new plant in Ohio. So they're opening basically a new manufacturing plant near the Columbus area of Ohio, and they basically started construction in November of 2021, I believe, and they are starting to move some of their manufacturing facilities and packaging facilities over to the US, or I guess the lower 48 states. They have a lot of manufacturing and packaging in Puerto Rico, which, as we'll talk about in the future further along in the video, is kind of possibly a controversial thing, I guess. So I think in general, it's good they're moving some of that toward the general 48 states because that, makes them closer to a lot of their customers. But I think it's also just to have those jobs, in America, which is awesome. And there's a little footnote at the bottom here that they also announced in 2021 plans to build another plant in the Raleigh-Durham area of North Carolina, which is pretty exciting. And together with the plant in Ohio, that's a investment of about $1 billion by Amgen in the United States, which is, for me, something that I think is very important to see. So looking at the net income numbers for 2021, in terms of GAAP income, they had about $5.9 billion, which looks like it's down substantially from about 7.3 in 2020. But they did make a significant acquisition in 2021 called 5 Prime Therapeutics, and that was about 1.5 or $1.6 billion. So that, had a pretty substantial impact on some of these numbers. But if we look at the non-GAAP net income, about $9.8 billion this year compared to 9.5 last year. So not a ton of growth there, and not a lot to show, but they did have that significant acquisition that's going to affect them a lot. And also one thing that I like is we can see in 2020 they had about 590 million shares outstanding, and now at the end of 2021 they only have 573 million shares outstanding, which is another good thing for current shareholders to see that they're buying back shares and generally reducing the number of shares rather than increasing that number. And now that we're into the actual 10K report that they are filing to the SEC, they talk about some, changes in their business and development, I guess. So the first one here is the 5' Therapeutics acquisition, which I briefly mentioned just a minute ago. So in April of 2021, they completed that acquisition, which is this company is a public clinical stage biotech company focused on developing immuno-oncology and targeted cancer therapies. So they bought that for about $1.6 billion, which is awesome to see that they're kind of expanding and taking on this other company that already has, some research and development done, and Amgen can kind of take advantage of that and hopefully make that company even better than it was before. And down here, they're just kind of talking about specific drugs and kind of what's going on with those and developments and progress made with those drugs, which I think is interesting to read, but we're not going to talk about all that in detail. And then they mention these plants again that they are building in North Carolina and Ohio, which I think is exciting. And it says that they expect both these facilities will be built faster and at a lower cost than traditional plants. Once completed, both will also utilize cutting-edge technologies to be more efficient and environmentally friendly than traditional plants, which is obviously good to see. The next thing we're going to look at is the balance sheet real quick. So first off, looking at the balance sheet, current assets around $19 billion compared to $21 billion last year. And they actually have about a $1.6 billion more of cash this year than last year. So one of the significant differences is marketable securities. I don't exactly know what that means, but they had a significant reduction there, pretty much cut all of those marketable securities. I'm thinking maybe that's something like a short-term loan or bond type thing, but I'm not exactly sure what that means. But current assets down a little bit. But when we look at current liabilities, those are only around $12.2 billion. And that means that their current ratio is 1.6. And the current ratio is basically just the current assets divided by current liabilities, which gives us an idea of the company's ability to pay off all current liabilities within the next year. And when we look at debt, we can see that their long-term debt is around $33 billion. And then the current portion of the long-term debt is only $87 million. So they have about $33.3 billion of long-term debt. And when we compare that with their total equity of about $6.7 billion, that gives us a debt to equity ratio of right around 5. And for a normal company, I would say that's, on the higher side. But for a company like Amgen that's, developing a lot of drugs and has to put a lot of money into research and development, I think that is fairly normal to have a debt to equity ratio that high. A similar company I would say is AbbVie, developing a lot of drugs, and they also have a debt to equity ratio right around 5. I guess it is important to note that oftentimes one of the biggest criticisms of AbbVie is how much debt they have. So in that case, you could say maybe 5 is a little bit high for one of these drug companies. And I certainly don't think it would be a bad idea to see some debt reduction. But at the same time, I don't think it's that big of a deal right now. And one of the other things I wanted to look at real quickly is kind of their revenue and how it's split up between different drugs. I meant to look at this before and show you guys, but I did not. So basically, each of these different colors represents a different drug and what percentage of their total revenues that this makes up. So you can see basically the trend that I see in this graph is that their revenues are becoming more diversified. So this light blue here was 23% in 2019 and is 19% now. This red was 14% in 2019 and is 7% now. And all other products that are small percentages were 21% in 2019 and now 24% in 2021. So I think in general, for me, that's a good sign because it means that they have a lot of drugs that are doing well, a lot of drugs that are providing substantial portions of revenue. Obviously, they're going to have some that are bigger than others, but I think to be more diversified rather than less when it comes to revenue streams is definitely not a bad thing. And I also wanted to briefly mention this website amgenpipeline.com, which basically just talks about all the drugs that are in their pipeline right now, and it talks about how far along in the process they are. It talks about what they're for and kind of a little description. For most companies, you're not really going to get in-depth information on all the products that they're selling and just all that information. So I think that's super cool that they provide that. Maybe they are, maybe they have to provide that for regulatory reasons. I'm not really sure, but I do think it's pretty awesome that they provide that. And so if people are interested, they can look at that kind of thing. And the next thing I wanted to look at was their Q1 for 2022 earnings. So they reported these at the end of April, about a little less than 2 months ago. So for the first quarter, total revenues increased 6% to $6.2 billion in comparison to the first quarter of 2021. And about 2% was because of a growth in global product sales. And then they also talked about volumes growing double digits for a number of products, including Repatha, Prolia, and Evenity, which were also some of the ones listed at the beginning of the 10K that also had some pretty nice growth throughout 2021. So it's good to see that they're still growing there. And then GAAP EPS actually decreased about 5% to $2.68 per share. And basically they say that the reason for that was because they realized net losses in this quarter on some equity investments and basically in the previous year they had net gains on those investments. So that's primarily the reason for lower earnings. But in terms of non-GAAP EPS, though, that increased 15% to $4.25. And partially they say that was because of lower shares outstanding. So obviously some of that increase is not really have anything to do with the company's overall performance, but it is good to see that they are decreasing shares outstanding like we mentioned before, and making each investor own a larger portion of the company. In terms of free cash flow, they generated about $2 billion of free cash flow in the first quarter, a little bit higher than last year in 2021 of about $1.9 billion. And they put out their revenue guidance, so around $25.4 to $26.5 billion estimation for revenue. And so they also talked a little bit about down here, basically a dispute they have going on with the IRS. And basically the gist of it is the IRS is saying they have to pay a lot more money than they think they need to pay. So the IRS is saying they basically owe $5.1 billion. And when you add interest into that, that's around $7 billion total. So that's pretty substantial. And the gist of why that is like I mentioned at the beginning when we were talking about the new plants in Ohio, they actually have a lot of their manufacturing in a subsidiary company in Puerto Rico. And so a lot of the profits from their drug sales, I guess, are sort of reported by that subsidiary company in Puerto Rico, since that company is a substantial portion of their operations. And the IRS is basically saying, no, you guys, Amgen, the American company, should be reporting those profits as your own, and therefore would be paying a higher tax or taxable income, and would have to pay higher income tax on those profits. So basically they're disputing that, and obviously that's not really a good look for a company, but I think it would not be a good thing for the company either if they had to pay an additional $7 billion in taxes. So that's just something to keep in mind. We're also want to look at the dividends here. So the dividend yield is around 3%, a little bit above 3%. And the payout ratio as well is around 41%, which is pretty healthy. I really like that payout ratio. And combining that payout ratio with the dividend growth rate around 11.5% over the past 5 years, I would say that's pretty awesome. I'm excited to see what they can do in the future. Basically, they've only been paying dividends since 2011. So they've only been growing the dividend for 10 years, so pretty much since they started paying the dividend. So they don't have a super long track record, which I do like to see, but again, that's not the absolute biggest deal since they just started paying the dividend recently. So for me, I think I want to see a little bit of a history. 10 years is fine, and they've been pretty consistent with the dividend raises. So that's really all you can ask for. And sometimes you have to take a little bit of a risk at the beginning and say, well, I think this company is going to continue paying these dividends, and then you can take advantage of a long history of paying dividends if they actually continue paying the dividend. So that's just something I like to think about. And in terms of valuation, as the next thing to look at, I wanted to look at the PE ratio. So what I did is just took their data for the PE ratio over time and just kind of charted that here. And so this first chart right here is from 2010 to 2022, and you can see the average over that time frame is about 17.6 compared with their current PE ratio of around 23.6. And when we zoom in, over since basically 2016 or 2015 time range, the average is 21. And you can see they had these big spikes here, and basically they had a lot lower earnings during 2018, which looks bad, but at the same time, it was just for a short time period, and they quickly recovered back to where they were before. And earnings have dropped off a little bit over the past year or two, but again, that's not the biggest deal, considering that they did recover pretty quickly. So if we actually remove these data points from those super high earnings, then it brings the average is down to around 15 and 17. So in that case, it looks a little bit more overvalued, around 23.6 now. So for me, I would say, the PE ratio is a little bit high. Granted, I guess this data is maybe like a week old, so the PE ratio is probably a little bit lower since the stock price has fallen. But again, 23.6 compared to, averages in the 15 to 16 range is a little bit high for sure. And when we compare that to the overall healthcare sector, the overall for the sector average is around 22. So pretty much about where Amgen is, and the average for the drug manufacturers industry is around 20, which is again pretty similar to where Amgen is at. And right now it says Amgen is at 22.9, so a little bit above the industry, but you have great companies like Johnson & Johnson at 23 as well right now. So AbbVie at 20. So it's not like they're the only ones that have this high of a PE ratio. So I think the PE ratio is definitely a little bit high, but it's not like anything too high that would deter me from wanting to invest in the company. And when we look at more of a valuation of like what is the fair value, that's where I use a discounted cash flow calculation. And basically from this calculation, I came up with a fair value of $248. And with a 10% margin of safety, that gives us a buy price of $223 per share. And currently that's just a little bit below the current price of around $230 per share. So pretty much right in line, I would say, with the current price. And so I think, right now is definitely not the worst time to be buying. As we'll look at on the chart, they've definitely been dropping a lot with the rest of the market. So we can maybe look at some trends there and try to figure out a good price that we would want to buy at. So right now, this is the 10-year chart for Amgen. And I was able to draw this really nice trend line that has acted very well as support over the past 10 years. They hit it back, in 2013, 2016, 2019, 2020, and 2021 as well. So they have really been bouncing off this trend line. And right now, the trend line is ending right around the 210 price range. So that's kind of where it's saying, if it were to, drop to the trend line, that's where it would act as support right now. So I think that's pretty interesting, as the current price really isn't that far off of that 210 area. And if we zoom into the 1-year chart, we can see they have some decent support in, the 215 and 225 ranges, which they're pretty close to 225 right now. And they have a lot of volume in this 225 range, which, if we remember, 223 was the buy price that we calculated in the DCF. So pretty much around 225 is looking to be a really good price. And I think if we get close to this support here, we could, see some sort of bounce up off that support, or at least not keep going down really. So honestly, 225 I think looks really good. And, if we saw the stock, drop below 225, I really don't think it would fall much below maybe 210 or 200. So honestly, right now, I think is a pretty good time to be buying the stock. at least from a valuation perspective, from a technical analysis perspective. I think there's some other things to keep in mind. Obviously, like we saw before, they have a lot of drugs that they're developing, a lot of drugs in the pipeline, a lot of drugs that are already producing lots of revenues and growing those revenues pretty quickly. In terms of earnings, their earnings have grown in general pretty steadily upwards, and at times pretty quickly over the past few years. They've been dropping a little bit. I would like to see a little bit of a reversal in that, which they are predicting a reversal in that, and they're predicting some nice increases in 2022. It'll be interesting to see how that actually shakes out. But I think if we can see some better increases in earnings, that would be awesome. The one thing that is a little bit concerning for me is the whole IRS tax thing. And in general, at this point, I don't think it's that big of a deal for Amgen, but just the fact that they have that dispute going on is a little bit of a red flag for me, and it makes me very cautious of the company, I guess. So that's kind of what I'm thinking. In terms of the balance sheet, I think it looks very nice. They could, reduce the debt a little bit, but it's not that big of a deal. And they do have some pretty good dividend growth over the past 10 years. Even though their history isn't that long, their actual growth is pretty good, and they've have been able to keep that payout ratio very low, considering how much they've grown the dividend. So overall, I think Amgen is really an awesome company that is producing what seems like great products that are producing lots of revenue. And I think for me, obviously I don't own this company at the moment, but if I were to decide to own the company, I think I would really be perfectly fine with the current price. I would definitely be buying some right now. And then, if I saw it drop further, I would definitely be buying some even more when it dropped further. So I hope you guys enjoyed the video. If you do have any thoughts to add to the conversation, drop them in the comments below. I appreciate everyone sticking around to the end, and I will see you all in the next one.